Kia ora, and welcome to the CoreLogic Property Market Update for Poutu Te Rangi, March 2023. Once again, the centre of intrigue came from the Reserve Bank of New Zealand this month. Their monetary policy statement, released at the end of February, was hotly anticipated, mostly because market analysts were interested in their take on the role of monetary policy in assisting relief and rebuild from the devastating impact of Cyclone Gabrielle. Usefully, they were very direct and upfront with their position, that it was too early to know the right role of monetary policy and that the fiscal and private response was much more important, particularly in the short term. Part of the reason for this is the heavy localisation of the devastation, meaning the whole country doesn't need monetary support. The other consideration is that extreme events have a stimulatory impact on inflation, which technically necessitates higher interest rates to fight that inflation. Importantly, the Reserve Bank chose to look through or effectively ignore the inflation impacts of the event, and by removing themselves from the short-term involvement in the recovery, actually provided some consistency and certainty to the broader outlook. Financial markets were relatively muted in their reaction, which would have been welcomed by investors. This was in a large part due to some of the main forecasts from the Reserve Bank staying relatively unchanged. Most importantly, the CPI inflation track actually fell slightly, and the unemployment rate projection was very similar to the view 3 months ago. Linked to this was the forecast of the official cash rate, which held a peak rate of 5.5%, despite the slightly lower than expected increase of 50 basis points to 4.75% at the latest Monetary Policy Committee meeting. One projection of note that did change was the Reserve Bank's house price forecast. The peak to trough fall is now expected to total negative 23%, ending in the early to middle 2024. Though in truth, most of the 23% fall is likely to occur this year. The extended fall and trough essentially reflect more data being included in the forecast, with it being 3 months since the previous update, and brings the Reserve Bank into line with many other economist expectations. That data includes the renewed downward momentum witnessed in house price indices. After 3 months of relative moderation in the rate of decline at negative 0.6% or less, the CoreLogic house price index for February fell 1.0%. This re-acceleration in price declines was generally expected, as any renewed positivity in the market has most certainly worn out after persistent inflation, further hikes to interest rates, and talk of a recession led to heightened nervousness for anyone willing, let alone able, to secure funding to make a purchase. That pool of buyers remains small, as evidenced by the total number of sales transacted so far this year, and the amount of lending being drawn down. The CoreLogic buyer classification series effectively captures this trend, and even first home buyers, who have shown greater resilience compared to other buyers recently, are showing signs of fatigue. 23.6% of sales in February went to this group, the second monthly fall in a row, after peaking at 25.6% in December. The group of buyers accounting for an increased share of sales in February were multiple property owners, who often have greater access to equity or funding and didn't need to secure a mortgage against their most recent property purchase. They're likely less affected by lending criteria and interest rates, and therefore making the most of a quieter market, retaining a long view and no doubt being selective of what and where they buy, mindful of the importance of yield in the short term. The balance of power remains in their and other buyers' hands, as the total number of properties listed for sale remains high, combined with the credit-constrained demand levels. Affordability for both market entrants and those with a mortgage due for refixing terms has become central to evaluating the trajectory of this downturn and its eventual end. The recent competition between banks for the limited pool of available borrowers, with sharp rates on offer below the line, has been welcomed by consumers, but the fact remains the jump from old terms to new is still being felt. Centrix reporting has shown a lift in missed mortgage repayments, and while it hasn't hit levels of major concern yet, it's certainly a watching brief. On a more positive note, we've now been in an increasing interest rate environment for 20 months, after mortgage interest rates bottomed out in July 2021. And across most measures, it seems the majority of borrowers are managing okay. Now, with rates at or near their peak, and fewer people rolling off the ultra-low levels of 2 point something, the hope remains that anyone refixing this year should also do so without too much trouble. As always, the labour market, where unemployment remains low, is crucial to this remaining true. So attention on large corporations resizing is high. So far, New Zealand hasn't seen the same level of scaling back as the tech companies in the US. However, it's getting closer and closer to home, so it can't be ignored. A deeper recession with greater unemployment definitely adds further downside risk to the property market outlook. There is plenty to pay attention to, so make sure you keep up to date with all the latest property market data and insights via CoreLogic NZ on LinkedIn, Instagram, Twitter or Facebook, and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.